Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Dearborn and Maddie Radner on the Nasdaq Market Intelligence Desk, as well as Chris Englebert, Chief Investment Officer and founding partner of Englebert Investment Advisors. We're here to discuss how to effectively communicate concerns and market observations with your advisor. It is great to have all of you with us. Welcome to Trade Talks. And Chris, this is an appropriate time because it's our 8th anniversary coming up in August as one of the first guests on the show. So thank you for everything over the years. It's been nearly a decade, but I think what's even more outstanding is what we've seen in the market over the past 8 years, because none of us could have predicted a pandemic and the ride that we've seen.
Yeah, just when you think it couldn't get any wilder, it has. I mean, I did some numbers here, and back in August of 2017 when we started, S&P was 2477. It's 6285 as of this airing, literally triple almost. The 10-year was 2.25. Now it's 443. I mean, as much as things change, they kind of stay the same. But I always tell people in the investment world, the only constant is change, is really what it comes down to.
Yeah, Chris, this is so interesting because prior to COVID, really, the big event was the GFC, the Great Financial Crisis, and everything that's happened in between. I mean, look how quick the COVID recovery was, or even what we saw from Liberation Day. Yeah. Investors are staying in the market.
The investing dynamic has changed to a point, but making money has not. And when you think about that mentality, who's changed the market more so? You're seeing retail investors more involved on a day-to-day basis. That dynamic was not there prior to the pandemic. Zero commissions, people at home the whole time. That changed the entire investing dynamic, especially when it doesn't eat into your alpha when you look in the trade. People would buy and hold. You would buy, 10 shares of Cisco, 10 shares of IBM, and you try every month to buy 2 or 3 more shares, and you pay $70 in commissions to buy those 2 shares. That's changed immediately. Plus, now you have all the different acronyms, FOMO, TACO, whichever one you want. People are looking at that and say, I want to be active, I want to make money. They see people out on X or any of the other places driving Ferraris. I want to be like that. The majority of the investors that we deal with are not, right? Steady Eddie, put your money to where it's working. But the big thing that's changed from 2008 to now is ETFs. And that is the biggest dynamic that has changed the investable world that people can be involved in. I don't have to pick a stock. I can pick a bucket of stocks. And the best performing ones are going to uplift it. S&P, 6250. Russell 2000, a little underperforming, but still not bad, right? Nasdaq 100, all-time highs. Composite, all-time highs. Even the Dow doing well. And then all the derivatives based on that value growth, any way you want to pick it. Yeah. There's so many choices for people to put money to work at right now. You didn't have that a decade ago. You had to pick individual stocks. Now you can pick the bucket. You can actively trade on your phone. You
could pick an individual stock ETF that's levered.
Yeah. Right, single stock.
After the GFC, did you expect that a product like that?
Yeah. No. Or how about the SKF, right? That was the product, the triple levered reverse ETF. I mean, when I was running my hedge fund, we traded that all the time intraday. Gave you a heartache.
Yeah. Yes, it certainly did.
And retail trading has just really taken off. It's something that we speak to every day with companies listed on Nasdaq. They might be up 10%, down 10%, and most of the time it is retail trading really active in their stock. It could be speculative, it could be based on a peer, it could be based on more macro headlines, but that access to everyone being able to jump into the capital markets is really notable now.
Well, I mean, it's interesting. The catalyst behind the overnight trading, we just had 2 Nasdaq spokespeople on last week discussing this, really was the retail trader pushing for it because they have exposure to digital assets, which they didn't, following the financial crisis. Overnight trading is something that they understand, and that really was the push behind it.
And to that point, to the broader market, we're a global marketplace, right? 2008, we were not. Right. You were U.S.-centric only. If you wanted to invest in the U.S., you had to get a U.S. broker to represent you. And if you wanted to buy internationally, you had to do the same. You'd have to go to somebody who would be investing in bricks or somewhere else. And you don't need that now. It's point, click, and shoot.
Yeah, it's incredible.
It's changed. So the question is, what's the next change?
Well, Chris, actually, a good question for you is how to be a good client, because you're seeing all these things happen.
Right.
And you still have to teach them to think long term.
Yeah. So, when I titled this "How to Be a Good Client." we get a lot of our clients from referrals, very like-minded people. We have a big law enforcement business. And one of my frustrations is I say to people, you're expecting us, you come to us and say, I'm saving for retirement, or I'm saving for college, or I'm saving, for a vacation home. Okay, what is it? What do you want to focus on? And don't change it every 6 to 9 months and saying, well, now I think I want to do this. The other thing, as far as being a good client, is I'm a little bit flabbergasted because we do a deep dive when we first get somebody to come on board, and we ask them some basic financial questions. What was your W-2 last year? How much is your mortgage amount? Not your mortgage payment, amount, and what is the rate? And it's stunning, Jill, how few people know the basics of their financial information, which is critical. Now, one of the other things that drives me crazy is a husband and wife. Oh, do you know how much your husband put in their 401k or your wife put in her 457? And they don't know. And again, in order to be a good client, you have to know those things so you can communicate if your situation changes. And then lastly, we reach out to our clients all the time. We're a little bit different advisory firm. We do a lot of videos. We push them out. And, I have clients come back to me and say, hey, we've seen you on Nasdaq TradeTalks with Jill, et cetera, which is gratifying. But we send out emails like, hey, time to check in. And it's not a long, conversation. It's 15, 20 minutes. How you doing? What's going on? I can always tell, we'll reach out to a client multiple times during the year, and I can always tell when they need money or something bad's happened, because that's when they want to have a meeting.
I was going to say, it's like you call your doctor when you're not feeling well versus going for your physical once a year.
Right, exactly. And I'm like, you really got to take more financial control. And I'm saying these things because it drives us crazy, because we're a very high-level service registered investment advisor, and we really try to give the service that people are looking for. But on the other hand, people are like, oh, I'll get to them later, or hey, we'll talk about this later, or all of a sudden, we get a phone call like, I just did this, now what do I do? Please talk to us before you do anything.
What's interesting? I remember one of the most interesting things that you had pointed out during the pandemic was how Zoom, as an example, changed things for you because you were more accessible to your clients. That wasn't the case prior to then.
No, and one of the things that a lot of RIAs would dread, and people would dread this too. They would be like, oh, we got to go into the office, we got to sit down for an hour, we got to do this. Now we can do it by Zoom. We can do a half an hour, 20 minutes. I can show you what's going on with your account. It's really a game changer, and a lot of financial professionals use it. But again, we're trying to reach out to the client to get that engagement so we know what's going on with you. So again, before something happens, we kind of have a heads up, like, wow, maybe your portfolio should be realigned this way, or if we've had a really good year in the investment markets, okay, now you can do whatever you're doing to your home in 2025 versus a year where, hey, it may not be a good time to take money out to do what you're trying to do.
Yeah, I mean, Chris, think about the technology and just how it's changed, back office work as an example. But I think what's a gift to retail investors, the platforms that are available to them, like a Schwab, for example.
You can get more data
than we
now.
had on the desk.
Right. When I was trading on the floor, you had only access to what was in front of you. We had a Reuters. It was on a little monitor up there, and you really couldn't see everything. You had to react to everything that was coming through. You're looking at the big board and like, all right, what's the 10 you're doing? Actually, back then, it was the 30. You're looking at the 30, all right, yields are down, buy, because there's always inverse to the yield. So you didn't always have the data that's in front of you, but also sometimes that gives you paralysis. Too much data can slow you down, so what do? You follow other people who are on some of the platforms like Reddit or other Discords, and you're following along. To Maddie's point before, the meme stock craze has not gone away. We only talk about the handful of companies like GameStop and AMC who were involved in it, but every day we have clients that are calling in because I've only got 2 million shares in my float. I've traded 15 million shares and it's only 10 a.m. Yeah. What is going on? And we have to explain that to them. So the data is there, whether you want to use it from a social platform or if you actually want to do your own investigating and look at the balance sheet. Look at what the analysts have to say about the fundamentals of the company. Are you cash flow positive? What's your trajectory to cash flow positive if you're not? And you can make good decisions there. Or you just pile everything into chip makers.
Yeah, well, there's that. Speaking of chip makers, your small caps, are they going to have a sustainable run? I mean, we're coming into earnings season.
For small caps, it seems like it's one step forward and two steps back for the past 2 years. At the end of 2024, small caps really priced in a Fed easing cycle, which has not really come to fruition. So, you know, the trade war and the sticky inflation that we've seen makes the rate cut path a little bit more uncertain. So we have seen them pull back a little bit more this year than we expected. I think investors, as we get into the earnings season with small caps, they'll continue to be really selective. They'll be looking at small cap companies with strong cash flows, low debt, and who are resilient with the kind of tariff theme that we're going to continue to see.
Yeah. Chris, what are you going to be listening for specifically this earnings season?
Well, I go with Maddie. She and I have been in the same camp the last 2.5 years that, you know, small mid caps tremendously undervalued. The gap between the Mag 7, you know, continues to widen. What I was watching off the bottom in April was the fact that the Russell finally started to perform. I mean, obviously the Mag 7's performed, but it's not up that much this year when you look at it overall. So I think investors are looking at the landscape. We've seen a big move in international this year. I don't think that's going away. I don't think the last couple of years, you know, international would pop up for one quarter. There's some structural things going on in Europe. You know, they're in their easing rate cycle. You know, there's some big, you know, infrastructure builds that are going to come in the next 5 years. So, you know, going into the back half of the year, you know, I'm still in the international camp. I'm still in the dividend camp. I'm still in the small mid-cap camp because I think investors are looking for other areas to put this money. And the hot money's chasing the tech stocks right now. But again, we've seen this movie before. Valuations, we talked off camera. I have people ask me questions about NVIDIA. I'm like, NVIDIA isn't just priced to perfection for 1 year out. It's priced for perfection not 5 years out, but it's literally priced for perfection 10 years out. So you're making a 10-year bet buying NVIDIA now going, there's going to be no other chips come onto the market, there's going to be no other competition. You know, you're making a lot of assumptions that are very difficult to make at this point in time.
Yeah, and Chris, it's interesting because fundamentals matter. Momentum is, you know, momentum is going to go as momentum goes, and fundamentals will matter at some point. But the momentum trade, it's really hard to step in front of that.
You know, fundamentals matter for 99% of the market. I mean, we were talking about breadth before, right? The S&P 500 today is flat on the day. You only have 70 companies that are positive in the S&P 500. I mean, it's unbelievable, and it's flat. The Nasdaq 100, only 30 companies are positive, and that's up almost 0.75%. So it tells you where the weighting is, and the weighting is where the money's following it. Granted, there's big news out today, NVIDIA, Apple, AMD, all of them. Really good stuff from an investor's point of view. Whether or not that actually takes place or not, we'll see if they start selling chips back into China, but we'll see. The fundamentals do matter. CPI came out today, right? You know, it wasn't necessarily hot, but it wasn't as cool as we were kind of hoping it would be. You know, you have rents increased by 2%, which is down month over month. Autos pricing decreased, which is good, but close up 1%. The unknown on the fundamentals is the problem that investors have to get behind these stocks. That's why the consumer discretionary spaces have or have nots, depending on where you're sourcing. Staples the same way. Nobody wants to buy salty snacks anymore. Lots of companies are getting hurt on that as well. Energy has been beaten up significantly. Yes, we've had a rebound, but is it, you know, dead cat bounce or not is another question. And the other sectors are just struggling as they go along. So if you're not chasing tech, you're not seeing the outsized returns. If you're not in the ETFs that we mentioned before that have tech as an outweighted member, you're not getting those returns. People are not throwing money away after indexes and sectors that are not performing. You can get 5% on your 30 right now, 4.5 on the 10. Why would I want to take that headline risk? I don't know.
Well, let's go back to the strength of the consumer and the impact of tariffs on them. Maddie, we had a panel last week and the week before where we had two companies with proprietary data linked to consumer point of sale and funding, and they both said that consumer debt is in quite a good position, and they're continuing to spend despite the data that we're seeing from a macro perspective and what we're hearing in the headlines.
I think the question now is how broadly will tariffs impact the consumer? You know, there's two sides to it. A lot of people think that tariffs will cause just a one-time price shock. Other people think that it will be more consistent, and it hasn't been really in the data yet. So I think so far companies have been able to stock up on inventories or absorb some of the costs. So I think there's still just a lot of uncertainty with the whole tariff native and how it will impact the consumer down the line.
Yeah, and Chris, as we look towards our next 8 years, God willing, what are you looking as you go through the end of the year? How are you talking to clients about?
Yeah, again, we came into this year figuring, bonds were going to do better in stocks. We were right up until, June, and stocks turned around and rallied. I don't want to sound like, that sky is falling person, but, we ripped down 21%, we ripped back up 30%. I still am looking for some kind of liquidity event, something happening in September, October to send a shock. Because if you look historically at the markets, once you get one big shock, you then tend to, within 6 to 9 months, get it followed by some other type of shock, either in the credit markets or something like that. And people right now are very sanguine about, hey, the market just came back. I mean, I took a call from a client the other day. She's like, wow, I opened my April statement, I was down. I'm like, well, have you opened your June 30th statement? You're up. So people that aren't paying attention think that things are that bad, and they're like, oh, okay, everything's recovered. I'm like, I don't think we're out of the woods. To Maddie's point, everything that we were worried about at the beginning of the year has not resolved itself going into the back half of 2025, and more importantly, going into 2026.
All right, appreciate the insight as always in support of the show, Chris, and thanks you guys. And thanks for joining us from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.